What are mutual funds? A mutual fund is simply a pool of money collected from many investors to invest in financial assets like stocks or bonds. Mutual funds give the common man the ability to easily invest in a diversified portfolio of financial securities. As an individual investor, imagine if you had to buy all the 500 stocks of the S&P 500. Instead, it is much easier to simply buy one unit of a mutual fund that pools money from various investors and invest collectively in the 500 companies in the S&P 500. Hence, the main advantage of a mutual fund is the low cost and ease with which an individual investor can get access to diversification and reduce risk. Mutual funds are operated by fund managers, who then allocate money to various stocks and bonds to generate profits or gains for the investors. These fund managers charge a fee for their services, which is typically deducted from the total assets or investment of the fund and paid to the fund managers each year. The quantum of fees charged by a mutual fund manager is very important and has a large impact on the investor's returns from the mutual fund. The price of a mutual fund is referred to as its net asset value, or NAV. The NAV is the sum of all the investments of the mutual fund minus its expenses and liabilities divided by the total number of shares of the fund. Investors can buy or sell mutual fund shares or units at this NAV price. Mutual funds can be divided into several categories. For instance, there are some mutual funds that invest only in stocks, or some that invest only in bonds. There are mutual funds for various specific investment strategies as well. For example, a fund that invests only in technology companies, or a fund that only buys junk bonds of high-risk companies. John Bogle, the founder of the Vanguard Group, is said to be the father of the modern mutual fund, and is credited with creating the world's first index-linked mutual fund in 1976.